Legendary investor Phil Correa once said that to lose money is the conventional penalty for bad judgment in speculation. And guys, this man knew what he was doing. He took a humble fund of $10,000 back in the day and turned it into an $8 million powerhouse. In this video, I'm going to teach you how to look at a cash flow statement and know in about 5 seconds if you are looking at a company that is a potential investment or a speculative play. Investments are stocks which we can hold in confidence for the long term, knowing that they're going to be solid. Speculative plays, on the other hand, first of all, require for you to be able to know if it's a speculative play, hence the point of this video. And always get a good entry, and if it doesn't work out your way, have a great exit plan. So let's talk about that cash flow statement and how to know if you are looking at an investment or a speculative trade. There is always a lot going on a cash flow statement that can be difficult to understand if you're not a financial expert. And this is not a deep dive video on the cash flow statement. It's how to look at it in 5 seconds and know if you've got a winner or one that has some red flags that you need to be spending more time digging into. So let's get into an example of a great cash flow statement. The very first thing that you're going to want to look for is at the bottom of the cash flow statement, the cash and cash equivalents at the beginning of the year and at the end of the period. And here on Costco's, we are going to look at February 12th, 2023. The beginning cash was $10 billion and the ending cash was $12.9 billion. It increased from the beginning to the end. The second thing that I noticed that is great on here is when we look back a year at February 2022, the number also increased from 11.8 billion over to 12.9 billion. This is what you want to look for to know that you've got a good cash flow statement in about 5 seconds. Now, if you want to spend a couple more than 5 seconds, let's talk about a couple of the other things on here. When we're done looking at this, we're going to look at a couple of Trainwreck cash flow statements. So hang on for that. That's going to be fun. The second thing that we look at, the next level of detail, is we want to compare on the cash flow from operating activities. Here at the top, you'll notice there's 3 different cash flows: operating, investing, and financing. When we're looking at the cash flows from operating activities, we're going to look at the top line, the net income, and then what is the net cash provided by operating activities. We want this number to be bigger than net income. That lets you know that you have a high quality net income. If the cash flow from operating activities is lower than the net income, then you're going to need to spend a little more time doing some analysis and understand the why. When we are looking at cash flow from investing activities, it might look a little weird to you, but this is how the company is investing its cash for the long term. In this particular case, you can notice that they spent some money on short-term investments. Those could be treasuries, and they also spent money on property and equipment. So although the total for net cash used in investing activities was a negative, they did invest it in short-term investments and to grow the company in property and equipment. So having that understanding of what these numbers mean is critical to understanding this second category. You might see positive numbers in this section if the company earned money off of some of their investing activities, as we have here, $512 million on maturities of short-term investments, or if the company sold some property or equipment, you would also have a positive number there. Bottom line, looking at a negative number on investing activities doesn't tell the whole story. You do need to take a moment to understand what was impacting cash flow from investing activities on a positive basis and a negative basis. The third and final category, cash flows from financing activities. What all is going on here? You notice here is negative 1.2 billion. Well, that might sound bad, right? It's actually the opposite of what you think. If you see a positive cash flow from financing activities, you can bet that the company probably took on some debt or they had dilution. That brought money in, cash into the company. What does it mean when we see a negative like we have here on Costco? Well, they repaid some short-term borrowings. That is good if you're an investor. They also repurchased some common stock, another negative on the cash flow from financing activities, but good for us as an investor. And finally, you can see that they had cash dividend payments, $400 million. Another bonus if you are an investor. And then remember, we just said if the company has dilution or they take on some debt, You will see a positive here in the cash flow from financing activities. We have proceeds from short-term borrowings, $479 million. So they borrowed money. That shows up as a positive cash flow from financing activities. Now let's look at some Trainwreck cash flow statements. But remember, for your 5-second overview, if you just want to very quickly look before you plunge in on something, you want to know that the cash flow from the beginning period to the end period is increasing, and that's also increasing from a look back period, whether it's the quarter before, the year before, or years before. The more of these you can go back and look at, look for that trend of increasing cash flow at the bottom of the statement. All right, let's look at a cash flow statement from a company which is having some problems. The company we're looking at is HellBiz here. You can see that they had a net loss. This comes over from the income statement, and that net loss was bigger than the year before. On their net cash used in operating activities, negative $43 million. Already not off to a good start here. In the investing activities, they also had a negative $6.5 million. I'm not going to ding them as much on that one because half of this was for purchase of property and equipment, and half was for acquisition of business net of cash acquired. But then we go down to financing activities, the bottom section. You can see that right here, this huge line item, $32 million, proceeds from issuance of financial liabilities. They took on a bunch of debt. They also had $3.1 million in proceeds from sale of Class A common stock. So they are diluting, they're selling shares. Now that did bring them in a income of $29 million on the cash flow statement, cash from financing activities, but you must recognize that that cash from financing activities was from debt and dilution. So if you're an investor, these might be red flags. But remember, if you're just looking at a 5-second overview of the cash flow statement, we don't even care about that. What was the cash at the beginning of the year and the cash at the end of the year? And we look over here at the beginning of the year, $21 million. At the end of the year, $737,000. That is a massive reduction in cash. And that was even though they had proceeds from the issuance of financial liabilities and selling common stock. They still had a massive reduction in their cash, almost broke at this point. If you're buying companies like HellBiz, now the ticker symbol changed to MCOM, and you're wondering why they're going down after a reverse split. Guys, it's not because of a reverse split. It might be because they're being shorted. Their balance sheet is an absolute wreck, and you can see from the cash flow statement that they are loading up on debt and they are diluting the shareholders. This stock is going to continue to go down. It's an absolute train wreck. Last one we're going to look at in the troubled category, Bed Bath & Beyond. Let's do our 5-second analysis and go down to the very bottom. Cash at the beginning and end of the period, right down here. We notice that for the 9 months ending November 2022, their beginning cash was $470 million, ending cash $225 million. So they are experiencing a decrease in cash. Also, when we look at the previous period here in the far right-hand column, you can notice that these numbers over here are substantially less than the beginning cash they had, which was $1.4 billion at the beginning of this period, and the ending $540 million. Again, 2 red flags you can spot in 5 seconds. Looking at the previous period, it has decreased to the current period. And within the current period, the beginning to the end, it has also decreased. 5 seconds, you already know that you got a problem on your hands. The big reason I've been saying to stay the hell away from Bed Bath & Beyond is if you go to the second level in your cash flow analysis, what is the only thing that saved their bacon? The cash flows from financing activities, and this is not good for investors. Bed Bath & Beyond had net cash provided by financing activities of almost $1 billion down here. You can see $968 million. Of that, $1.225 billion was borrowings of long-term debt. They also had another $118 million from issuance of common stock. Imagine for 1 second how bad this number, $225 million, would be if they didn't have the income, the cash flow positive $968 million. The total cash at the end of the period would be damn near negative $750 million. Now that was back in November. This is still going on, and the issuance of common stock is going to be even worse on the next quarterly statement. So the 5-second rule for cash flow statements is go to the bottom, look and see if it's increasing from the beginning of the period to the end period, and is it increasing from the prior period to the current period. If that all looks good, then you might have a pretty solid investment. If on the other hand, you're seeing that cash is decreasing from the beginning to the end, or from the previous period to the current one, that should throw up a red flag that you might be investing in a speculative play. And remember, if you choose then to invest in a speculative play and the price goes down, you can blame the financials, you can blame the condition of the company, not shorts, not manipulation, not naked shorting, not the CEO. Well, maybe the CEO. But it's incumbent on us, the investors, to take the 5 seconds to look at this stuff so that we don't get a bad entry in a failing company. Always remember Phil Curay's words: to lose money is the conventional penalty for bad judgment in speculation. I encourage you to take a couple seconds, just 5, to look at the cash flow statement, look at the balance sheet, look at the income statement, and make sure that you are making a good judgment before you rely on due diligence from somebody on Reddit, Twitter, or YouTube. I am Tony Denaro. I hope you found this information valuable, that you learned something from it, that it improves your investing. Thank you for watching. Hit the like button on your way out the door, and I will see you on the next video.